consideration, I see that he's here, of the defeasance of the bonds, of the outstanding obligations of the Series 2016 bonds. You're just in time. I mean, you rolled in and...
I'm trying to see again.
I am.
Because it wasn't too sneaky. Good evening. My name is John Roebuck. I'm the financial advisor to the district. I have the privilege of serving as financial advisor for a period of time. And this is an item that we've done, I think, for the last 3 or 4 years, where we've been able to pay off some debt and lock in some savings and basically manage the tax rate because of so. And what we're looking at today is to do a cash basis of about $6.1 million. And do we have a presentation loaded? Ready to push this button? We have an opportunity to cash defease about $6.1 million of 2016 bonds that lock in some savings. And, whoops. So these bonds have a call date of February 15th of 2026, and they all have coupons of 5% interest. So by cash defeasing these, we lock in, basically, actually we pay them off, and so we realize that 5% interest is being basically paid off early, so we realize that savings, which is shown on the next page here. We save about $1.4 million by paying these bonds off. So we'll deposit a cash payment of $6,891,000 to pay off the bonds, and then there's about issuance costs about $12,000, which again locks in paying off those bonds, $6,180,000, about $2,060,000 in years 30 through 32. And once those things are locked in, we no longer obligation to the district. And as a result of the cash defeasance, the tax rate model we're showing here is what the tax rate would be for the 23-24 year, 34.81 cents in the debt service side. And that's keeping it flat from what it was last year. And then after that, the tax rate will drop by about 6.25 cents in the following years, unless we decide to pay off more bonds by locking in a higher interest rate or a higher debt service tax rate. To do so, we're asking you to approve the defeasance resolution tonight. And then on February 1st of 2024, we'll actually structure the escrow, lock in some securities to earn interest until the call date in 2026. And then on February 15th, we'll actually close, and those bonds will be considered defeased in the eyes of the district. With that, I'll be happy to answer your questions, but this is something we've done for the last couple of years to manage the tax rate and also lock in savings for taxpayers.
So a lot of people, and myself included actually, don't always understand all the ins and outs of school finance, but conventional wisdom is don't pay off cheap debt when the cost of borrowing money is high, right? And so right now the cost of borrowing money is much higher than it has been, 5%. It's not a crazy interest rate. Would you explain why you pay that off?
Pay off right now, so interest rates we sell bonds for actually have coupon yields, and these actually have a coupon of 5%, so we're paying 5% on these bonds. And so that's actually about 1.5%, 1.25% higher than what the current market is. So we just pay these bonds off again, create capacity, lock in savings, and we have the cash to do so. So might as well do it.
Kind of the opposite of the consumer market on the other side. Yeah.
Any other questions? Since you're here, and we were having a budget workshop, I do have a financial advisor question.
Sure.
When we talk about our days of savings in our financial rating when it comes to bonds, what does the bond market look like, or what happens to our rating if our days of reserve decrease, or where does the market like to see our days of reserve? Make you earn your money tonight.
Without a doubt. Lots of facets to that question. So if it's a one-time drawdown, no effect whatsoever. They want to see about 90 days with the reserves. You get less than that for a year, no big deal. just build that back up. If it's multiple years and you continue to draw that down to 30 days over a 2 or 3 year period, you'll see the rating companies come back and probably put you on notice or watch. But again, it's gonna take them about a year or two before they downgrade you. But if you,
You might be referring to general fund as well, not just that service.
no, I'm talking all funds, all fund balances, the general fund and debt service. Actually, the debt service fund is,
Not even relevant.
right, well, 'cause I know what that is, so we're trying to manage that right now. But for the maintenance and operation general fund, yes, it's one-time drawdown, not a big deal. If it's a pattern over 2 or 3 years, yeah, it could basically be a red flag to rating companies.
So help me understand, because my understanding of the bond rating piece for a school district, I think, big question mark in my brain, is a little bit different than like city bonds. Cause my understanding of it is that the government kind of holds a bond rating for it, like we all go to a pool as school districts, and we use a bond rating from the state level,
Well-
that they hold us harmless kind of thing. Can you help me understand that piece?
Yeah, so, a little different, yes, you're correct. So a city would issue bonds based on their underlying rating. Right now, there's not bond insurance out there. What the school districts have the permanent school fund guarantee we can apply for. It allows us to sell the bonds with AAA ratings. So there is a market difference between school districts that have underlying rating of AA2 like you do, and let's say A rating, about 5 or 10 basis points difference across the yield curve. So y'all are still gonna be selling bonds with AAA rating, pay a permanent school fund guarantee, but the rating companies can come in and downgrade their underlying rating if y'all continue to draw down the fund balance to an unhealthy level.
And you're calling it unhealthy 30 days?
No.
It can, it really just depends. I mean, they're not gonna look at it if it's a one-time drawdown, but if you maintain that about 30, 60, or less than 90 days for several years, and it continues to be pulled down even further, yeah, they're gonna, it's gonna cause red flag, and they'll come in and ask questions.
We would wanna manage at that level by any
Yeah.
means, but just trying to get a true understanding of what's true risk and and where does cause I've heard a lot about the permanent school fund, and that was a big issue, like they needed to stretch that to more dollars because of all the bonds that were being issued across the state. And so I was trying to understand how that played into what we have going on, so thanks for that.
Yeah, and really, the permanent school fund guarantee only comes to play when you sell bonds, it's not ongoing. So the rating companies are gonna have their underlying rating, which we go talk to rating companies every time we sell bonds, and that rating is what the underlying rating is for the district. And right now, you're AA, AA2, so you're 2 notches below AAA, so you're in a great place.
Thank you.
Perfect. Thanks for answering that question. All right, any other questions about the board while we have them? None? Okay. So I'll go ahead and ask for a motion to approve that agenda item B1 as presented.
So moved.
Second.
All right. So we have a motion by trustee Carbone and a second by trustee Scheffler. Hearing any further discussion, we'll go ahead and call for the vote. All those in favor? All those opposed? Motion carries 6-0 with trustee Weinberg absent. So thanks again for your gracing us with your presence tonight.
Thanks,
Thanks, Mr. Rivera.
Thank you, appreciate it. Captain.
All right.
For you to have
That-
everything back.
That'll move us into agenda item B2, which is the approval of the fiscal year 22-23 budget amendment. Mr. Berger.
Yes, sir. So what you have before you is a June budget amendment that's being presented. If you have questions, Ms. Carter will come up. It deals with that confusing thing of the GASB pronouncement where we put the leases on there. Some of these are software leases, or a majority of these are software leases. And then we also have a food service fund correction that we're bringing before you.
Long time no see.
So are these both washes?
They're washes.
Okay.
The 199, the general fund is a wash. The food service fund.
Is a correction.
Incorrectly reduced revenue, so we're bringing it back up, I'm sorry. But I did wanna use this opportunity right now to clarify something, in the conversation about fund balance. For us to make payroll, we need those 90 days of fund balance because several months go by without getting any revenues. So I just wanted to make sure that if we were clear, we can't do ever 30 days of fund balance.
Nor would we recommend.
Nor would I ever recommend it, just wanted to clarify.
Okay, so I would move that we approve